The fact that we have three massive gargantuan record asset bubbles existing concurrently for the first time in history is not my interpretation. It is a fact. Credit, equities, and real estate. The fact that they're growing and continue to grow, I mean, that's great for me and my clients. We're participating in the bubble, but be aware that if you're not with an active manager and you're just going to buy and hold 60-40, you can cancel your retirement.
Michael Pento, president and founder of Pento Portfolio Strategies. It is so wonderful to welcome you back to the show and great to see you as always, Michael. Really appreciate you taking the time.
Greetings from Nome, Alaska.
No. Okay, it looks beautiful there wherever you are because I think like now we're getting like our first freeze. It was 47 degrees here in North Carolina.
Yeah,
Matt, our producers in New York, I'm sure it's freezing up there, but
it's very chilly here. It's 75. It's terrible.
Oh, okay. Well, time for the Ugg boots in Florida.
Yeah, I know. People here are walking around in windbreakers.
Get hot coffee. Yeah. Anyway,
so good to see you as always, Julia. Thanks for having me back on.
It's always great to see you, Michael. I have to say, you are a fan favorite on this show. Every time I have you on, the comments are always so positive and so nice. And you're one of our favorites. So thrilled to have you back for the fourth quarter here. Let's get that update. Let's start where we always start. Big picture, macro view, where we are today, where you see things headed. What is on your radar right now? What are you paying attention to as it relates to the economy and the markets? And as you know, Michael, you could take all the time you need to set the table.
Well, I could spend an hour talking about it. Well,
my audience would love it.
I try to give a Reader's Digest version.
Okay.
Well, first of all, I manage money for a living, and please take these comments in the context of I am net long the stock market, up handsomely in the portfolio this year. So I'm not a perma bear. However, the foundation of this gigantic, enormous record-setting bubble, it's just unprecedented and so scary. So I can give you some facts on that, and I'm definitely going to get to it. But the fact is that I look at the second derivative of inflation and growth. We had some inflation numbers finally out this morning that showed, even though Wall Street's celebrating, year over year in August, inflation CPI was up 2.9%, and in September it was up 3%. So in my way of looking at things is the rate of change, second derivative, is that inflation is accelerating. It's up to 3% year over year, not 2.9%. And so the rate of change is accelerating, not only just the first change. And it's been above the Fed's target for 4.5 years. And yet the Fed is so panicked about keeping this bubble growing, which, by the way, I'm participating in. My model is built to participate in these bubbles, but to recognize when the bubble ends. And they're hell-bent on panicking now. They're cutting interest rates, as you know. They'll do it again next week. They are ending quantitative tightening. In fact, quantitative easing has started. The Fed's balance sheet has actually increased in October. So we're no longer shedding assets at the Fed. We're actually increasing the Fed's balance sheet. And they're just panicked about keeping this bubble going because the reverse repo facility, which is the excess reserves in the banking system, which was in July of 22, $2.5 trillion. It's now at zero. So that excess liquidity that was just flooding into the stock market through first you buy bonds and then that money leaves the fallow balance sheet of the Fed and goes into the economy. That number is now zero. So the Fed is proactively panicking, trying to get the interest rate lower and ending quantitative tightening to keep the bubble going. And we're participating in it, but it's such an enormous, gargantuan bubble. The economy is the most bifurcated as well. It's, as everybody has been saying, that it's a K-shaped economy. I like to say that the bottom 4 quintiles have been eviscerated by inflation. And it's just the top 20% that's actually still be able to spending and consuming and living off the fumes of the housing bubble and whatever left in this bull market. But the size and scope of these 3 asset bubbles, which is stocks, bonds, and credit, is earth-shattering. So if you look at total market cap of equities to GDP, which is my favorite metric, it's also Warren Buffett's favorite metric, it's now 220% of GDP. The mean ratio there should be around 80%. In the Y2K bubble, it was 140%. And in the global financial crisis, it was 107%, just prior to those bubbles popping. If you look at the massive housing bubble in 2006, and engendered the global financial crisis, the home price to income ratio was around 5, and today it's over 5. So it's at a record. And that's just the home price to income ratio. And that's not factoring in insurance or maintenance. Or mortgage or taxes, which are all through the roof. So there's a record low affordability metric on housing. And then you have things like the credit bubble. There was $400 billion of leverage loans issued in Q3 of this year alone. So it's a record amount of leverage loans. The private credit market was $100 billion just prior to the global financial crisis. It's now $1.7 trillion today. U.S. margin debt is at a record high. Is $1.06 trillion. It's up 33% year over year. Household equity ownership is at a record high as a percentage of their assets. And total non-financial debt is now $77.9 trillion. That's 256% of GDP, much higher than it was prior to the global financial crisis, and much, much higher than it was just before the NASDAQ bubble burst. So you can call me a Cassandra. You could say that you're being hyperbolic, and that would be a misinterpretation of what I'm saying. The fact that we have 3 massive gargantuan record asset bubbles existing concurrently for the first time in history is not my interpretation. It is a fact. Credit, equities, and real estate. The fact that they're growing and continue to grow, wonderful. I mean, that's great for me and my clients who are participating in the bubble, but be aware that if you're not with an active manager and you don't have a model that measures and maps that second derivative of inflation and growth, that monitors recessions and financial crisis and a freezing up of the credit markets, if you don't have that and you're just going to buy and hold 60-40, you can cancel your retirement.
Yeah. In other words, that is the risk, is so many people, that is how they have their retirement set up. And yeah. Okay, as you point out, Michael, 3 gargantuan bubbles you just laid out there. But you also point out you're not a perma bear. You are still net long the equity markets right now. It does make me wonder, like, are you like nervous when you get long? Does it make you nervous being long? I don't know. Like,
yeah. Julia, it's a great question. If I didn't have this inflation, deflation, economic cycle model that I took decades to develop, I wouldn't be able to sleep at night. Because that's how dangerous this is. I mean, how do I know that today the market's not going to melt down? Because the model that I created looks at arcane components that let me know when the people in the know, when the people that run the biggest banks, the shadow banks and the primary dealers, people that run this planet, the oligarchy that runs this planet, when they get nervous, they take action. When they know the assets on their balance sheets are about to crumble and erode, that's in the vanguard before CNBC talks about the market meltdown that day. When they start taking action, and I will see that in my financial conditions and credit spreads that I monitor, I will know when I have to react ahead of time. It won't be the exact top of the market, but it'll be around the top of the market. So I don't have to suffer the 30, 40, 50, 80% drawdowns that are coming. Because, Julia, when this next meltdown occurs, and we've had meltdowns before that were all the result of a recession or a credit crisis, and the Fed came in and the Treasury came in and they monetized it all away. I think there's a salient risk that this next crisis will be born out of spiking bond yields. In other words, it'll be a credit crisis that's caused by inflation and insolvency, not just insolvency. When assets minus liabilities are negative. And then there's nothing they really can do about it, because if the bond market is in full revolt because inflation is run intractable, and we have some kind of protracted stagflation, I don't think you can solve that problem by creating more inflation. So you can have inexorably rising long-term bond yields. In other words, I think the crisis might not be truncated, might not be abbreviated like the 2008 crisis was, where, from say December, I think the market peaked in the summer of 2007, and then it stopped going down in March of 2009.
Yep.
Right? It might be much longer than that because of the intractability of the bond market.
Okay, let's explore that point, because as you point out, there's that risk of the spiking bond yields and the bond market being in full revolt. It's like understanding the bond market is incredibly important to this. So can you kind of flesh out the implications? Because I know like so many different things are like priced off of the long bond. So
Correct.
Just like unpack it for us a bit further.
So not only are you beautiful, you're very intelligent. That's why I love coming on your show.
Oh, thanks, Michael. I mean, you have the best vocabulary, I gotta say.
Well, I'm not beautiful or intelligent, so I have to be erudite and loquacious. So what's priced off the long end? The benchmark lending of the Treasury is mortgages, corporate bonds, auto loans, student loan debt, all priced off the long end. So if you have a spike in long-term bond yields, I know the Fed controls the short term, but they do not control the long term unless they actually engage in something called, interest rate repression, which I have no doubt they'll engage in that when they have to. Let's just say the 10-year goes to 6%, and Powell pulls like a Mario Draghi in 2012 and says, we'll do whatever it takes. We'll buy every single Treasury issued, just like Japan has done too. But the problem is that even in, like what Japan did that, when Shinzo Abe did that, and Kuroda did that in Japan, and when Mario Draghi did it in Europe in 2012, the problem was insolvency, but it was not inflation, it was deflation. What if the problem is both? And then they start doing this interest rate repression? I don't think it works. And then you have spiking long-term bond rates. And what do you think spiking mortgage rates would do to the housing bubble at this point? It would create, we're already down 15% here in parts. I'm in Naples, Florida. We're already down about 15%. And I think if interest rates went to, on the mortgage end, 7-8%, you'd see 20-30% again easily. And it would be ubiquitous. It wouldn't just be idiosyncratic in Florida, or Texas, or parts of Nevada.
Also, just makes me think of like the demographics too of like those who own the homes right now as well. And
well, you know what else? People say, and they're correct, that the underwriting standards are better this time around. They certainly are. I mean, okay, so instead of putting nothing down like they did with the ninja loans, the no loans, now FHA is doing loans for 3.5%.
Oh, I was typing in this morning because I saw a house and I was like, what would an FHA loan be on it?
3.5% down. So 3.5% when the housing market is down 20%, you're still way underwater on your house. And that's when you mail, jingle mail, you mail the keys back to the mortgage. You just rent because you're not going to pay. You're not going to pay a mortgage when you're down 20% on the house. You're not going to pay a mortgage, a full price mortgage like that. You're not just. That's what happens. You just walk away from the house.
How about all the houses that are now owned by like financial institutions? It seems like a new development in the last, I don't know, since the financial crisis.
Well, that's another point. I'm glad you mentioned that. I was going to say that before you reminded me, but institutional investors now own 25% of all single family homes. That's a new phenomenon. So yes, the underwriting is better, but the calculation is, so I'm up 100% on my portfolio of homes and I have a renter. I'm so happy. But then the calculation switches from, this home price is now dropping. I have a huge profit and my renter is now out of a job and he's no longer giving me that income stream. All I have to do is call my real estate agent and say, sell this house. I don't have to worry about changing my address and packing up and moving. It's such an easy calculation just to sell your portfolio of homes. And, 1/4 of all single family homes fit that category. That's why the Sun Belt is in such a bad shape. Because everybody moved here from COVID and said, maybe if I don't even move here, or even if I did move here, I'm going to buy my house and 3 others. So many people that did that, Julia.
Yeah. And a lot of people have investment properties too, or they have like, they're trying to Airbnb things or Yeah,
of course. And when your renters, when the rental income dries up and now you're sitting there paying, wow, I don't have a renter, or even if you do, but in many cases, when the unemployment rate does spike and we do have this crisis, you're going to lose your income stream. They'll stop paying. They'll move in with their, families move in together. And then your calculation is, wait a second, I'm paying this massive maintenance on this property. Insurance has gone through the roof. The taxes have gone through the roof. And my home price is now dropping. It's such an easy decision. Sell the house and lock in the profit. But everybody does it at the same time, and home prices just plunge because the supply just surges. Listen, it's just a fact. The home price to income ratio is at a record high.
It's
higher than it was.
Crazy. Yeah.
It's crazy. And people can't afford homes. That's why the transaction market is mostly frozen. And then you add to that the credit bubble, and you add on top of that the equity bubble, and you could see the situation developing. It's so fragile and tenuous. I'm not saying this to scare you. I'm not saying that you need to exit now. Again, I will be out of the stock market for the most part. I will be short the market. I will be in the short-term treasuries. I will most likely be in the dollar and long gold when this occurs.
Mm-hmm.
That'll be my portfolio for the most part. I'll have to do some technical analysis of the way gold's behaving at the time this occurs. But it'll be a risk-off event, which could exactly encapsulate gold as well. I'm not sure, but we'll see. But you'll need to change your 60-40 allocation, because just like in 22, if you're in the 60-40 allocation and your salesman / broker says, well, the 40% sleeve of bonds will offset the 60%. Well, no, that didn't happen, because both bond prices and stock prices went down in 22 because both were in a bubble. I think the same thing's going to happen again.
This episode is brought to you by VanEck's Rare Earth and Strategic Metals ETF, ticker symbol REMX. Rare earths are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. VanEck recognized this early, launching the Rare Earth and Strategic Metals ETF, ticker symbol REMX, 15 years ago, well before supply chain security became a global priority. Today, China dominates the production and refining capacity of rare earths, creating real challenges for global supply chain security, as these materials are essential for technological innovation, clean energy, and national security. That's why countries all around the world are racing to build their own supply chains and reduce reliance on China. As this global shift continues, investment in the rare earth ecosystem is growing rapidly, from mining to advanced manufacturing. Investors can gain access to this powerful trend through REMX. Visit vaneck.com/REMX Julia to learn more. Okay, speaking of that allocation, like, what does that new structure look like? I've heard various folks say, you want like X percentage in like hard assets, like gold being one of them. But what do you think? What would the new 60-40 look like?
Well, it would probably be something like 25-30% shorts, 50% T-bills, and then some combination of the dollar and precious metals, gold in the vanguard there, much more than silver and platinum, because they both have industrial components.
Mm-hmm.
So that's what the portfolio would, somewhere around there would look like. And then in that case, Julia, when the stock market and bond market melt down, obviously short-term bonds will do well because the Fed controls the Fed funds rate, and the money markets compete with each other. So there's, if you look at 2 years or shorter duration in Treasury bills, they'll soar in value as the Fed cuts rates to zero again. You'll make money in that part. Cash will do fine too. You can't get hurt holding cash. Shorts will explode higher.
But what about with inflation, though? Like, would that take away the purchasing power of the cash that you hold?
Yeah, but you won't lose money in nominal terms.
Oh, got it. Yeah,
in nominal terms, and you'll be and depending on what's happening with inflation and the long end, you might be short. Like I am short the long end of the bond market right now, and the reason is simply not because I'm expecting the credit crisis to emerge right away. I'm preparing for it already, but just simply because a 3.8% 10-year Treasury note makes no sense to me. When inflation's at 3% and and real GDP growth is around 3%. That's 6% when I went to school. I had got my degree a long time ago, but 3 and 3 used to be 6.
That's 6, yeah.
And a 6% nominal GDP is right about where the 10-year note should be trading, not 3.8. So the 3.8 is already presaging a meltdown in the economy. So we're not getting that right now. So I don't know what upside's left on the long end of the bond market. I think the only upside is if we have a meltdown in GDP, which is not obviously not occurring yet. It could, but in that case, as I said, I would buy the short-term treasuries. But what if the meltdown in GDP occurs at the same time that stagflation and interest rates are rising? It's not going to help you to be long the Treasury note. Like I said, mortgages freeze up, home prices crash, people default on their student loans, auto loans. You had 3 subprime auto loan dealers just go out under. I know that's idiosyncratic right now, and we're not supposed to worry about it.
Are you also referencing the First Brands thing?
So First Brands, Tricolor, and then there was another one that just went under too.
I wanted to ask you about that. Is that kind of
prime lenders or something like that?
Something like that.
So, which specializes Prima lending, specialized in the riskiest of auto loans.
I wanted to ask you about that because is that kind of signaling or foreshadowing what's to come? Because when we're talking about the credit bubble to the private credit side of things too. Do you think we're just seeing like early tremors? So if you look at total non-financial debt, and then you add private equity in there, we're at 317% of GDP. So the private credit market has exploded. And I don't think people understand the danger involved in that. I mean, private credit is basically, I'm a corporation. I can't get a loan from the bank, the primary dealer. And I can't float the corporate bond market. I can't float my debt there. So I go to the shadow banking market, which gets its loans from the primary dealers. and I get a loan out. And then since it's private, there's no market for it. And so I just tell these people what I think this loan is worth, this income stream is worth. And then when the income stream dries up in a recession, as it always does, and then people call their shadow bank lender and say, I need to get out, there's no market. Oh
so
my
it's,
gosh.
30 cents on the dollar.
And there's probably a reason they couldn't get it in the first place, like the normal way.
Because the reason is they're very small and they usually have very poor balance sheets. So it's the riskiest profile of loans in many cases. So it's a disaster waiting to happen. $1.7 trillion.
Wow.
Of private.
And you said it was 150 billion before 2008.
It's and 1.7 trillion now.
Wow. Okay. Big bubble there. All right. I wanted to ask you too, Michael. It's a totally different topic, but gold. The move that we've seen in gold in like the recent weeks and months. I know we had the other day I recorded an episode where gold was up $164. The next day it like sold off. Now I'm looking at it, it's 41.49. We're recording on Friday, October 24th in the afternoon. So just what do you make of like the run up that we've seen in gold?
Well, there's so many factors going on with the gold market. First and foremost is we see central bank buying, China, Russia. So foreign creditors no longer want to park their savings in treasuries and dollars because of sanctions and confiscations. They want access to their savings without having to go to the United States government. So they're eschewing treasuries and dollars and taking their surplus and just buying gold. That's number one. That's a big function. The other issue is, of course, we have the insolvency of the United States, the $2 trillion in debt, in deficit. So per annum, we just passed $38 trillion in national debt. 38 trillion. I think the start of this year, the debt was 36 trillion.
It definitely was. Because I bring it up on a lot of episodes. Yeah. So I'm sure when you and I spoke earlier this year, it was probably 36 trillion and taking 36 higher.
Trillion.
Yeah.
So, I mean, it's just, the Fed is now lowering the competition for gold by lowering the money markets. So if I can stick my money in a T-bill and get 4.5% when inflation's at 3%, it might make sense. If inflation's going higher, and it is, and my T-bill rate is going below 3%, and it will, especially when President Trump puts his man in there, or woman, in May of 26 as the head of the Fed, then it makes sense. The competition for gold is going away. So people are scared of owning dollars, and they're running it even domestically into the precious metal. And then you have the new phenomenon of the individual investor is now realizing that bonds are not a real ballast, and Bitcoin is not, cryptos in general are not a real ballast against liquidity crisis. And to some extent, gold isn't either, but it's much more of a ballast, an offset to your portfolio than cryptocurrencies or bonds. So in that regard, we have individual investors now saying, you know what, maybe owning 5-10% of my portfolio, even higher, into precious metals, holding them and investing in them makes a lot of sense. So those three factors which have caused gold to go up. And so, when gold gets a lot of momentum and the chart goes vertical, well, it's susceptible, like anything else, to sharp drawdowns. But you have to ask yourself, well, which one of those phenomenons has changed? Are central banks now dumping gold or stopping buying gold? No, they haven't. Is the Fed now raising interest rates? No, they're not. They're lowering interest rates. And I think that phenomenon of individual investors buying gold is just getting started. So yeah, it's susceptible to 3, 4, 5% moves in one day, but it's also susceptible to long-term bull markets. Where it rises. I think we're up like the gold price is up, I think 45-50% this year.
I'm checking. Yeah, I'm sure. I know it's outperformed equities, which probably unusual. I don't know. I think that's probably unusual.
It's been that way since the year 2000, Julia.
See, so
it's not that. Yeah. I think it's about 40 or 50% this year, off my memory.
Yeah.
Check it.
Yeah, please. I'm looking right now. I don't know. My computer's super slow at the moment, but I totally believe you. Everybody knows this who watches this show, but I bought gold in August of 2011. I won some money in college and I put it all in gold. And that wasn't like the best time, but I didn't do anything with it and I just haven't messed with it. And now when I get my statement, it looks pretty good. So I just didn't mess with it. And I have no plans of doing anything with it.
Good for you.
Yeah, maybe that makes being a lazy investor here.
Yeah, it's never good to be lazy investors.
Not lazy, but I just wrote it out.
So year to date is 56% on gold. One year is 50%. Year over year, it's 50%. Not too shabby.
Not too shabby. And gold is definitely been a really popular topic on this channel. And it's kind of funny because a lot of folks have been talking about this debasement trade before it went mainstream. In the last couple of weeks, it felt like, okay, now everybody's talking about it. But
I've been talking about it for decades.
I know. So, I know. You're one of our guests.
Yeah. I mean, I said this, the dollar is not going to, I didn't say the dollar was going to go away. I didn't even say the dollar was going to lose its status in a bull market against the yen or the yuan or renminbi or whatever, or the real. I didn't say that. But I said it's losing its status as a world's reserve currency, and it's definitely going to lose its value against hard assets. And this is, gold never goes up or down, the value of it. That's what makes it so beautiful. It's a perfect store of wealth. But, I mean, you look at, put a chart of what a dollar would buy in 1913 and what it'll buy you today. It's just like, I now go to the store and I don't take change anymore. I don't even deal with change anymore. And pennies used to be nickels used to mean something.
Oh yeah, they're totally.
Now it's just a nuisance. It's a nuisance.
It's a nuisance. It's probably kind of dirty too, and it's totally diluted. Which we've seen how that plays out from previous empires that diluted their
98% of the purchasing power of the dollar is gone, and it's gonna it can't go to zero, but it'll be some fraction of just a fraction of what it once was.
And that quarters used to be silver.
Yeah, well, it's called. That's where the word debasement. You infuse base metals into the denarii, which used to be silver. So that's exactly what's occurring. We're debasing the currency, and all you have to do look at what gold. That's why everybody in Wall Street hates gold, because gold is the revealer of what's happening, because it's what the dollar is doing against real and honest money. And it's not too good.
It kind of calls it out. Then maybe it's calling out everything.
Yeah, it calls it out. It says, hey, "Look, this is what you're doing." Not against. I mean, if Japan is debasing its currency and it's a race to the bottom, you might not. It's not as evident as you look what's happening with gold. Here, this is the dollar and this is gold.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. I like that. It's the revealer.
Yeah, the great revealer.
The great revealer. Okay, one of the other things you said earlier about these concurrent bubbles that are growing is that the Fed is going to be so panicked about keeping the bubble growing. What do you think they're going to ultimately do? Like, I guess they'll cut rates, but will that just further fuel the bubble? Like, kind of walk me through how you're thinking about the Fed and the role in, I guess, expanding these bubbles.
So the Fed is panicking. They're trying to pre-panic. They're not slashing interest rates in panic mode, but they're trying to like obviate the need to cut rates by 50 basis points, 100, like they did in 2007 and 2008, where there's like, in the summer of 08, Bernanke just said, hey, we're just going to zero. We're just going to just cut them down 100 basis points. Boom. Let's just get there. They're trying to preclude that from happening. I don't know if they're going to be able to avoid it, but they're trying to avoid it. I don't know. I mean, that's the answer is I'm not sure what's going to happen. I guess if I had to guess, it'd probably be a little too late. But for a while it'll work, and then it'll be too little too late. They're going to have to panic. And that means going back to ZIRP, zero interest rate policies, and back into QE, and then some form of helicopter money too. Because do you think Donald Trump is going to sit idly by and watch the stock market crumble because Powell was too late? He's going to say something like, I predicted this would happen. What we need now is Besson to get in there and send stimulus checks out to people and have the Fed monetize them all. Trillions of dollars. In fact, he already said he wanted to send, hey, why don't we send a $2,000 stimulus check out to people in the form of some kind of cryptocurrency? America coin, maybe we'll call it.
So this is also assuming this would happen before May 2026 too. Before, I guess, what was it you said last time? An obsequious sycophant will be the next.
Obsequious sycophant. That was
obsequious sycophant. This is okay. You should watch this show if you want SAT words too. Those are
So someone who's very easy, someone who does the bidding of someone else and is very eager to please. Obsequious, overly eager to please. I think that's the exact definition. But that's it. Yeah. So that's what we're going to have at the Fed, who says, you know what, I want to get ahead of any problem, and I'll just cut rates to 2% from where they are now, 4%.
Mm-hmm. Okay, but won't that also, we have the two mandates, and will we see a reacceleration of inflation when they do that too?
They don't have a dual mandate. They really they have by law a dual mandate. But in essence, they have one mandate. I'll tell you, you know what the mandate is, Julia?
Can I guess?
Yeah, go ahead, please.
The stock market.
Yeah, you're such a... That's why I love you. The stock market is their mandate. Their mandate is, I need to protect banks' assets in the stock market. Mm-hmm. That is my mandate. And that's why, if you looked at any other reality, I mean, the unemployment rates, what is it? It's historically... very, very low. It's like 4.25 or something like that.
Something like that. I know it's really low. I want to say 4.2.
It's very low historically. The average is in the 5s. So it's very low historically. We have quiescence in the initial claims, at least when we had them before the government shut down. You have near record tight credit spreads. Financial conditions are easy. At the moment, housing bubble, unaffordable, stock bubble, credit bubble. What is inflation has been above the Fed's asinine target for 4.5 years. They should be tightening interest rates. They're cutting interest rates because they know, like I said, they're pre-panicking over the reverse repo facility. They don't want the freezing up of the credit markets like we had in 2019. And that's when the repo market rates shot up. And that's long-term rates shooting up too. The whole bond market begins to melt down. and that would cause they want to make sure that the market stays as phony as possible. But what they're going to end up doing is, because they already got the insolvency down pat, we already have that, a $38 trillion national debt. The whole debt, if you look at the national debt as a percentage of income, it's 770%. So you understand how bad the debt is to income. You can't tax GDP.
Right.
You have to. We're looking about income. The income is pretty much static. If you raise taxes too much, you don't get any more income. If you lower taxes, you don't get much more income. So the income is you can't tax GDP. At 100%, your income would be zero. No one would go to work. So it's debt as a percentage of income, not debt to GDP, that I look at, and it already shows that we're
And are you talking about GDI, like gross domestic income, or income, like
debt
people?
As a percentage of revenue?
Revenue. Sorry. Yeah, revenue. Okay.
It's 770%. That's insanity.
It's
terrible. Go to the bank and ask them for a loan. If I went to a bank and I said, I'm adding 40% to my debt that's outstanding. I'm not paying down my debt. I'm adding to it every year, because $2 trillion is 40% of the revenue, which is about $5 trillion. And oh, by the way, the debt is 770% of my income. Can you give me you want to give me a loan? And they'll laugh at you. They wouldn't even give you a lollipop on the way out the door.
You're a total zombie at that point. Yeah.
You're totally, thank you. That's what we are.
I stole that from James Lavish. I can't say credit, but we are zombie economy.
Yeah. It's only working for the top 20%. The asset bubble, known as the stock market, is only working for 7 companies make up 34% of the entire S&P 500. The leverage in the system is at a record. The concentration in the system is at a record. The value of the system is at a record. And having said all that, you might say, Mr. Pento, why are you long the stock market? Because it's going higher.
Well, you know how to ride it. Yeah.
Yeah. But you have to ride it safely. I do have some ballast in the portfolio. I have a small short. I have the right kind of shorts in the credit markets. So even on a down day, I wouldn't get killed. I have precious metals. But my model will tell me when I need to actually genuinely get worried about this stock market. So if the stock market goes down one day or 2 days or 3 days, and my model will say, is this just a normal hiccup? Is this just like a normal pothole? Or is it emblematic of the incipient erosion of the credit markets? And I need to at least pay attention short term.
Well, you let us know when you get actually super worried what to do. Especially.
I'll take action for my clients first.
Yeah, of course.
And then I'll reach out to you.
Yeah, you have to telegraph that one. On the Fed too. Okay, so they should be tightening then. What should they do?
Yeah. Julia, if you have let's just say you have a dual mandate, and it's full employment, and it's stable prices. That is their dual mandate. And I said to you, okay, so how you doing on the, full employment? And you say, well, the unemployment rate is well below its historical mean. Okay, good. All right, let's look at your other mandate. So how are you doing on stable prices? Well, we haven't defined stable prices as 0 anymore. We define them as 2%. Oh, why did you do that? That's not stable. That's 2%. Okay, but that's what we did because we were worried about the assets in the bank eroding. Okay, so we redefined it as 2%. Well, how are you doing on that front? Well, it's 3%. Well, you're 50% above your target. So if you have your unemployment below average and you have your inflation way above average, well, what would you do? Well, of course you'd be raising interest rates. Mm-hmm. Right? When you do that, an honest person would say, I have to do that. And then you add on top of that the fact that the middle class has been eviscerated and the dollar is plunging because what you have done, Mr. Powell, mostly Mr. Powell. But by the way, if you want to know why I'm not invited on the mainstream financial media anymore, you don't have to guess because you could just listen to this interview. They don't want this out. They don't want the truth out there. Mm-hmm. But the truth will set you free, as they say, and the truth is very scary. They have destroyed already the middle class, and they're going to do it even. They're going to step up.
And that's why we've seen the rise of independent media too.
Yes, independent media. My business I was thrown off CNBC, Bloomberg, Fox. I was thrown off every media outlet in 2000, and pretty much in 2012. And then my business started booming because I went on shows like yours.
Okay, so I'll tell you, I used to be in the financial media. And I always wanted...
What channel?
I was on Yahoo Finance was the last place I was at. And I always wanted to like host a show, and I never got a show. I pitched a podcast, and that's okay. It didn't happen. Yes, but I'll tell you, I used to get like these big interviews, like big guests, like Jeffrey Gundlach. I had Paul Tudor Jones and others. And the problem that I found was the conversations were so limited to sound bites. And so what happened was they started putting my content on YouTube because I'd say, well, I have 25 minutes with Paul Tudor Jones. Like, he's not going to be a 5-minute hit. Sorry, that's crazy, in my opinion. Or like Jeffrey Gundlach, we'd air the full 45 minutes on YouTube. And then people would come in the comment section and say how much they loved it. And like they were learning, oh, thank you for not interrupting your guest. And then that's where I was like, oh, people on YouTube want to come and learn, and they want to listen. They don't want to get a sound bite. They don't want to see the guest cut off, So,
Julia, when you think about why God put you on this earth and everybody has a purpose, you're doing the Lord's work here. You really are. Because if people would just understand and grasp what we're talking about the enormity of the three bubbles and the need to protect themselves. I mean, you don't have to, I'm not saying become my client. You don't have to become, I manage money for a living, become my client. There are other people out there that are wonderful have a robust model, but at least get away from this, what I call the deep state of Wall Street. These are mostly salespeople who are just going to tell you, and it's not my opinion, it's what they do. I used to work on the Florida Stock Exchange in the 90s. So I have many, many friends in the industry. I have 35 years experience doing this. I call them, glorified used carpet salesmen. They're just taking your money and just asking your age and your risk tolerance and then plugging into some 60-40 kind of rubric model. And then they'll tell you when you call the phone and say, we're down 20% this year. And they're going to say, don't worry, hold on. The market always comes back. That's what's going to happen. But sometimes it takes 15 years for the market to come back. And if you look at other markets outside of the US, sometimes they never come back, or decades like it did in Japan. We're still waiting. I think the Shanghai is down like 40-50% since 2008. Sometimes it takes decades to come back. If you're near retirement, you don't have that kind of time. And I liken this era to 1989 in Japan. That's what we're looking at. That kind of multi-decade loss.
Like a lost decade.
Lost decades in nominal terms, and in real terms, you get wiped out. I mean, if the market goes down a 50%, and then 100, and then say in 20 years it goes back to even where you were, so it gains 100% to get back to even. Well, if you're there the whole time, you're even after 20 years. But what has your inflation rate been in those 20 years? What is your real purchasing power of that money? It's been wiped out. So if we can avoid that downturn, participate in the downturn by shorting it, and then buying close to the nadir of the bottom, close to the bottom, isn't it much better than just trying to be a salesperson? Mm-hmm. You can do better. You can do better. And I think you need to.
When you look at how we got to where we are here, when you look at the three bubbles, what do you think ultimately drove it? Was it Fed policy? Like, what do you think it was that drove it? And what would kind of be the fix? Is it just letting things kind of like wash out of the system? Like maybe it's having, recessions. They're probably a healthy thing to have too, versus like blowing up the ultimate mother of all bubbles.
Well, there's no doubt how we got here. I mean, there's no doubt. In fact, I put a presentation out. If you email me directly, through one of my assistants will send it to you. It's just a PowerPoint presentation of the Fed's balance sheet, the level of the real interest rate you can lay all this at the feet of the Federal Reserve and the Treasury. The debt outstanding that we have. So it's just like, hey, when you take interest rates for zero for almost 14 years, then people borrow money and they buy stuff with it. They leverage up their margin account, they buy houses, and corporate America goes bonkers, leveraging up, businesses leverage up. And that's what causes this bubble. That's engendered this massive bubble. There's no doubt about it. You can email it. It's mpento@pentoport.com, or if you go to the website and contact us, and someone will send you that PowerPoint presentation.
Yeah.
For free. You get it for free.
That's really kind of you. Okay, so you mentioned K-shaped economy earlier. I know you were on Adam Taggart's show, Wealthion. I want to give him a shout out because I thought this was an interesting way of describing it. He calls it, this is what my viewer said, a lowercase I economy, where you have like everybody at the top, like the top percentage owning like all the assets, and then everybody else at the bottom, like a lowercase I. I thought that was an interesting letter to use.
Well, now I'm jealous because I love Adam Taggart. I'm on the show with him all the time. And whoever came up with that is a genius.
My viewer said it was Adam, so I don't know. I haven't fact checked. I'm going to say it was Adam. Yeah.
Okay, it wasn't me because that's way better than me.
I know. I was like, that is a good one.
Hey, one is down and one's up.
Yeah.
No, it's a little tiny. Because I said it less eloquently. I said it's the top quintile is doing well. It's the top 20%, and the bottom 80. But that I, lowercase I, that's the 80, and the dot is the it's the Julia La Roches of the world.
Yeah. No, I don't know about that. No, it's like, I think it's supposed to be the dot is like the top, like everyone up top.
Yeah. The top 20%.
Oh yeah. I don't know about that.
That's you. That's you.
No, I don't.
That's you and me, kid.
Oh, I don't own a house. So there's that. I'm one of those millennials is like, I'm waiting for those housing prices to come way down. And there are two that sold last year that I just saw that are listed back on the market this year. Yeah.
North Carolina is one of those places that people escaped. That's one of the recipients of the COVID wave.
Okay, let me tell you what's going to happen in New York City. You feel like people are going to come back?
So I have another house that I have in Naples that's for sale. I think what's going to happen in the biggest city in America, you're going to get a socialist communist as a mayor, Mamdani, and I think that's going to get a lot of people to.
I think so too. Yeah, I'm like,
to go to North Carolina and drive up your home price even further.
I know, that's what I was thinking too. And also when you go to the Rangers games down here, it's great because the tickets are cheap to go watch the Hurricanes, but you kind of feel like you're watching like with all the New Yorkers down here, the Rangers games. So that's kind of fun. But I don't know. Are you a Jersey Devils fan or something?
No, I hate them.
Okay, good. We don't like them either.
I like the Rangers and the Knicks.
Except for they got rid of my favorite player on the Rangers, so I'm kind of upset about it. So
who's
Chris
that?
Kreider. I've been a Kreider fan forever.
Oh, no, I know. He was
anyway,
fantastic.
I digress here. All right, before I let you go, Michael, what's something that's keeping you up at night? I know you sleep well, but that's on your mind, and what's something that is making you optimistic about the future?
Well, what makes me optimistic is the Lord is in charge, and He's blessed you with this wonderful show, and we get a lot of people that listen to it. You see, Julia, if the distortions were on the margins right now, I say we could have a healthy, cathartic, purging recession, and home prices would fall a little, and the debt can be rebalanced, and it would be okay. The distortions have grown so gigantic, in such gigantic proportions that any kind of real healing or mean reversion would entail a depression. So if you look at the total market cap of equities to GDP at 220, and the average is 80, you're talking about a more than a 50% decline, assuming the denominator doesn't fall, and the denominator always falls. So what do you think this economy would do at a 50% decline in the stock market? That's why they're so hell-bent on keeping the bubble afloat. But the bubble will eventually break because they're going to borrow and print, monetize so much debt, you're going to have intractable inflation, and that's what's going to cause the long end to break. Until then, we could be, flowing along comfortably. But that's what keeps me up. Yes, on the negative side, The positive side is shows like yours that we can rescue as many people as possible. On the negative side is that any kind of reconciliation, or I call that the great reconciliation of asset prices and debt, is going to be devastating for the economy and for most people. And that's what keeps me up at night. What's going to happen to the average person who doesn't know how to protect themselves? You know, like I mentioned before, ownership of equities among households is the highest it's ever been in proportion to their assets. So everybody's long the stock market. And if you're an idiot and you own bonds and you're like, or precious metals or any kind of hedges, well, that's what you are. You're an idiot. You're underperforming the S&P 500 by, a few percentage points. I'd rather underperform by a few percentage points and have a robust model that makes me protect and profit from that great reconciliation than just constantly chase it and just, get left holding the bag.
Yeah.
When people do sell, they'll panic at the bottom and just drive it through the dirt.
Yeah. Well, I am grateful for wonderful guests like yourself, and you are certainly a fan favorite on this show and always welcome, and we always love our conversations. Michael, again, let folks know where they can find your work. What was your website again for them?
So it's Pento Port, PORT.com. And on that, you'll see a contact page, to contact my firm. If you have about 100,000 to invest and you're suitable for the portfolio and you are a U.S. citizen, I will manage your money personally in the IDEX strategy. And if you don't, and you just want to access yourself to the midweek reality check, it's $50 a year. And it's my weekly podcast where I talk about the salient issues and the data. When there was data, there's no really data anymore because the government's closed.
Yeah.
But maybe they'll open
just a
up
CPI report this morning. That's it.
Yeah, that was it. Just it.
Yeah.
And the market liked it because it was less than feared, but still going in the wrong direction. So I'll give you the real interpretation of that every week.
Michael Pento, founder and president of Pento Portfolio Strategies. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping all of us learn and get better. I really, really appreciate you. And I look forward to our next conversation. We'll have to get one on the books at the start of 2026. Thanks again, Michael.
Thank you.